What's the best indicator for stock trading? Is it the Fibonacci, which is based on numbers and ratios that show up in nature? Is it the moving average, which helps smooth out price data and helps you to see the direction of a stock? Or is it the RSI, which stands for Relative Strength Index, and it helps you to identify strength or weakness of a stock? There are many more popular indicators, but I'm here to just speak on just two, the two indicators that are the most reliable and accurate of them all, and that's volume and relative volume, or RVOL. Both of these indicators display their data in real time, meaning that unlike the majority of other indicators, they do not lag behind. They offer extremely useful data, and I believe every single trader can and should make use of it. In fact, they're so powerful that you can make a lot of money trading stocks with either one of these indicators alone. No other indicators required. Let's first talk about volume and how it works. It's actually really simple. Basically, volume shows how many shares have been traded over a specific period of time, whether it's 1 minute, 5 minutes, 1 hour, 1 day, 1 week or 1 month. It all depends on the time frame you're trading on. The more volume there is, the more interest there is in the stock from buyers and sellers. Volume is usually displayed at the bottom of the chart, and you can even display an average volume line just to get a rough guide on how much volume is traded on average. This is updated when each candle has been completed. So how can volume help you with your trading? Well, there are three major ways. The first way, and perhaps the most important, is that it helps you to identify institutional buying. You want to be in the stocks where the big boys, i.e. banks, hedge funds, pension funds, etc. are putting their money into. They're the ones that are mainly responsible for driving the stock up. And when institutions are invested in a stock, they typically buy more and more over a period of time, and they hold for the long run. So you still have plenty of time to jump on board. Unless, of course, the stock gets so overextended, in which case you'll see institutions selling into strength. Again, this footprint of selling will be reflected in the volume. This is unlike micro or small cap pump and dump stocks that can shoot up hundreds or even thousands of % within a few days and then crash back down to earth. These kind of stocks are a lot more speculative, and retail traders can often be a driving force behind these. So in short, if you see a huge amount of volume in a stock at the early stages of a stock's growth cycle, combined with bullish candles such as a green Marubozu or a hammer, then it's a positive sign that institutions are accumulating a position in the stock, and it's likely to continue going up. Of course, getting in at the right time without getting stopped out and making a profit in the end is another story. Volume also helps you to identify real bounces. When a market or a stock is in a downtrend, how do you know when it's over? You can't just randomly buy a stock just because you think it's gone down far enough and the current price is cheap. That's a recipe for disaster. Just when you thought it couldn't go any lower, it does. Seasoned traders usually wait for signs of institutional accumulation that comes in the form of volume and support. When that happens, it usually means that the downtrend is nearly over and a bounce or uptrend is due soon. A bounce without volume is just a dead cat bounce, and this temporary recovery will just resume its downtrend within several weeks. Keep in mind that during the bottoming phase, there will probably still be bad news floating around, but despite the bad news, the stock no longer goes down. This is another sign of strength, so don't be confused by this phenomenon. If you're trying to catch the bottom, then you could wait for an exhaustion move to the downside and buy in when you see a strong close on huge volume, which should exceed or come close to preceding candles. You need to be patient waiting for this setup, because they don't appear very often, but if you do catch this move, you can simply hold it and enjoy the ride on the way up. This setup is more rewarding, but always a riskier play and you could get stopped out many times over before catching the real move. There are going to be moves where you think the stock should bounce based on its climatic move to the downside, only for it to make another low several days after. This happens just as often as the stock taking off. So bear in mind that no setup works 100% of the time, and you should always be aware of this. On the flip side to a bottom bounce, volume can also show signs of peaking. This typically happens when a stock has been uptrending for a while and gets into the overbought or overextended territory. Institutions will begin unloading their positions over days or weeks. This will be apparent when there's high volume accompanied by bearish candles such as a red Marubozu or a shooting star. Also, there's often a bearish pattern that follows, such as a double or triple top. Support levels will be broken and lower highs and lower lows will appear. During the peaking phase, don't be misled by the good news that comes out about the company. This is just PR fluff that encourages more buying so that institutions can sell to unwitting buyers. So if you've identified signs that the market or a stock is peaking, then you can short the move or at least avoid buying the stock. You can make a decent profit in a short space of time by shorting the peak, since stocks typically drop faster than they rise. However, shorting is trickier than catching a bounce, and you could get stopped many times over before actually catching the real drop. Shorting the peak requires a lot of skill, timing and luck, so it's not for the faint of heart. The last thing you want to do is wrongly time a stock that goes parabolic. You can easily blow up your account. So now that I've covered enough about volume, let's move on to my second best indicator, which is the relative volume, or RVOL indicator, compares the current volume of a stock with the stock's previously traded volume over a certain period of time, depending on your platform settings. So in Finviz, it compares the current volume with a 3-month average of the stock. In the trading platform I use, which is Trader, it compares it over a 4-week average. So the higher the relative volume is, which is usually displayed as a ratio or percentage, the more buyers and sellers there are for that particular stock at that current time. So how can the relative volume indicator help you in your trading? As an example, if you're trading breakouts, it allows you to see if there's a relatively good amount of volume when price breaks through whatever area you've determined the breakout is. So if the relative volume is less than 100% or a ratio of 1, you might want to pass on that setup since there's not enough volume. However, if it's 200% or a ratio of 2, meaning that the stock is trading double the amount of what it usually trades, then you'll play the setup knowing that there's a good amount of volume behind the move. Of course, there are many times when the volume won't come in until later on after the stock has broken out. In this instance, the RVOL indicator won't really help much, except to let you know that there's not much relative volume behind the move. Another setup that the RVOL works really well for, and one that I personally trade all the time, is the EP setup, or episodic pivot. This is when a stock makes a significant move, usually in a pre-market or after hours, due to a catalyst like an earnings report. When there's a catalyst, the RVOL should usually be high, sometimes trading over 10 times the volume it usually trades. If I see that the RVOL is extremely high before the market opens and price has gapped up over some major resistance levels, then I'll put it on my watch list for a potential opening range breakout entry for when the market opens. For this setup, I only consider stocks trading over 400% RVOL during the market open, meaning that it has to have over 4 times the average volume and it has to maintain that amount of volume. If it falls below it when it breaks the opening range, then I'll pass on the trade. That's my rule, but obviously the entry criteria will be different for different traders. Without the RVOL indicator, I would be blindly guessing the volume and will end up taking many unnecessary losses on setups with low relative volume. There are lots of different ways you can use the RVOL indicator, but the two setups I've covered are probably the most common ways to use it. So to conclude, volume and relative volume are my two best indicators, which I've utilised to consistently profit from the stock market. Let me know which indicators you find the most reliable, and if you have any questions, just drop it in the comment section below. Remember to drop a like and subscribe for more swing trading tips. See you in the next video.